All right, class. Now, welcome back, everyone. Now, we'll continue from where we stopped in our last period. And like I promised you, that the first thing we're going to do is for us to review these past questions that I asked you to go and look at. And I want to believe that you have all looked at it. So, this was a question of May 2024 diet. And this question centers around preparation of consolidated statement of financial position as at October 31st, 2023. And we asked to also explain how investment in subsidiaries should be accounted for in a separate financial statement of the parent. Now, again, when you're asked to prepare consolidated statement of financial position, the entire principle is based on the principle of cancellation, where we are going to cancel out similar items, similar transactions between the members of the group. And obviously, the members of the group here are Sokoto and Niger Limited. Sokoto appears to be the parent, Niger appears to be the subsidiary. And we can easily guess from the investment in Niger of around 1.6 million. Of course, this will be cancelled out against the equity of the subsidiary. Now, in order to have more insights, we'll look at the additional information. Here, we're told that Sokoto Nigerian PLC purchased 70% of the issued ordinary shares of Niger Limited 4 years ago, when the retained earnings of Niger Limited were 160,000. There had been no impairment of goodwill. This note 1 basically focuses on determining the holding of Sokoto in Niger. And also, we're told the pre-acquisition retained earnings. No big issue here. Secondly, we're told that for the purpose of the acquisition, the plant and machinery in Niger, who is the subsidiary, with carrying amount of 400,000 was revalued to its fair value of 480,000. We're then told that the evaluation was not recorded in the account of the subsidiary, and depreciation is charged at 20% using straight line method. Now, who is bold enough to tell us how we are going to address this principle? I need somebody to tell us very fast. Sharafa, can you try this? What are we doing here?
Okay. The revaluation is a revaluation surplus.
But before you continue, Sharafa, hold on. So I don't know. Can you hear any background noise from my place? Is there any disturbing noise from my end?
No.
No. Okay, good. Oh yeah, continue, Sharafa.
Yeah, so this created a revaluation surplus of 80,000.
Okay.
So, and that will increase our plants and machinery.
Okay.
And then the 80,000 also will will be added to our net asset acquired, as will be factored into our net asset acquired in the calculation of goodwill.
Okay. That's perfectly correct. What about the depreciation side?
Okay, the depreciation, obviously the depreciation will have been understated initially. So the 20% of that 80,000, which is that's 16 for 4 years, will be 64,000. So we will go and lessen our plant and machinery by that 64, and then the retained earnings of the retained earnings of food. That's the subsidiary. Sorry, the retained earnings of EBA, post acquisition retained earnings, will also go and reduce it on it.
That's perfectly correct. But that will be the retained earnings of who has the machinery. That's Niger.
Niger Limited.
Yeah, retained earnings of Niger. That's absolutely correct. Absolutely correct. So the 80,000 would bring up the asset of the subsidiary to this amount, while the other leg, which is the surplus, will be a pre-acquisition reserve that will be added as part of what we're going to cancel out as part of net asset acquired. And also the under depreciation, we need to now charge depreciation by making sure that we deduct it from the asset and also we deduct it from retained earnings. And for 4 years, it's going to be depreciation for 4 years because we acquired the subsidiary 4 years ago. 4 years depreciation will be considered. Perfectly, Sharafa, nice one. Now, the next one talks about Sokoto Nigerian PLC sells goods to Niger Limited at a markup of 25%. And at the end of the year, October 31st, 2023, the inventories of Niger Limited included 360,000 of the goods purchased from Sokoto Nigeria Limited. Who should I call for this? Okay, let me call Balkis. Balkis, can we try this? Okay, he's not ready. So let me call Moses. Moses, can we do this? Okay, he's not ready. Can we do, can you try this one, Joseph? Okay, so Sharafa, I have to come back to you. So how are we treating this?
Okay, so there is an unrealized profit in that regard, and that's unrealized profit of that's 25% of 360 for your unrealized profit.
Okay, so yeah, so Sokoto sold goods to Niger at a markup of 25%. And included in the inventories of Niger is 360 of goods. So 360 of unsold goods, right? We sold it at the markup of 25%. Now, since this is markup, we cannot apply 25% of 360,000. You cannot apply markup on selling price because this is the selling price of that goods. This already includes profit loading. So if you are doing 25 over 100 of this markup, that 25% is markup. So we will need to add profit loading. We will need to make whatever it is, this 25%, we need to increase it so that it can be at the level of this 360. Because this 360 includes profit loading. This 360 is at 125%. One is at 125. So if you are given markup, you cannot just say 25% times 360. No. You need to convert that markup to margin. And basically what we are doing is that you need to, instead of doing 25 over 100, you are going to do 25 over 125. Just to bring the base to the same level as this 360. Because this 360 includes profit loading. So it's going to be 25 over 125 times 360. Right? Because this is selling price, you cannot apply markup on selling price. You need to convert it to margin by doing 25 over 125 times 360. So whatever unrealized profit, that's the unrealized profit. So with that, you just need to remove that unrealized profit from the retained earnings of Sokoto and also from the inventory of Niger. So that's that. Also, we're told that Niger owes Sokoto 280,000 for goods purchased, and Sokoto owes Niger 120,000. Okay, so these are going to be cancelled out. And this, it looks easy, but it's very tricky. Because first, look at this 280. Niger owes Sokoto 280. So that means in the receivables of Niger, 280. In the payables of Niger, 280. In the receivables of Sokoto, 280 needs to be cancelled out. The same thing, Sokoto owes Niger 120. In the payables of Sokoto, 120. In the receivables of Niger, 120. That has to be cancelled out. So invariably, if you want to cancel this out, you see these receivables of Sokoto, it includes at this level, inside Sokoto, there is 280 because Sokoto, this guy is owing him, Niger was owing him 280 because we're told that Niger owes Sokoto 280. So inside there is 280 here. Here also, there is 120 here. There is 120 here because Sokoto was also owing Niger 120. So when you are canceling out, when you are consolidating, you're actually removing 400 of intra-group here. And the same thing here too, 400. 400 being 280 plus 120. Okay? Because there is 280 payables here. There is 120 payables here. If you add the two together, is 400 that needs to be eliminated, right, from the two sides. And that's all really. So good policies to value NCI at fair value. The market price of the shares of NCI shareholders just before the acquisition was 1.5. And you know that when NCI is measured at fair value, you need to get the number of shares that the NCI owns. You need to get the number of shares that the NCI owns. You then multiply that by the share price. Okay? And in this case, how many shares does the NCI owns in Niger? He owns, he has 30% holding. So since it's the nominal value €1, so you do 30% of this amount, that gives us the number of shares. Then you then multiply that by the market price. Okay, so all I've explained, the solutions are here from the evaluation surplus that we are treating as a pre, and also we are adding it to the plants, to the depreciation, which is 20% times the revaluation times 4 years, which we are going to remove from the plant and from retained earnings, to the intra-group transactions, which I say to be 25 over 125 times 360, which we are going to remove from the retained earnings of Sokoto and inventory of Niger. Then we compute our goodwill. And this is how we would calculate the value of NCI, 30% of the number of shares times the share price against the net asset of the subsidiary. So it gives us a goodwill of this. Then consolidated retained earnings as usual, remove the pre, depreciation remove from the subsidiary because of that under depreciation. Then the unrealized profits remove from Sokoto because it was the one that sold. Then we get NCI, and that's it. And the receivables, while we are adjusting for what we need to adjust for, and you will see that in trade receivables I remove 400, and in payables I remove 400, like that. Now, so Then apparently only Salahuddin, only I said Salah, only Sharafa was able to look at these questions. The rest of you didn't look at it. Moses, I called you, refused to answer, and you could hear me. Joseph, Balkis, Yetunde, the four of you, you'll be in trouble. So, November 2022 is another question that has to do with consolidated statement of financial position again. Lest I forget, we're asked to explain how investment in subsidiaries should be accounted for in the separate financial statement. Who can answer this? How do we account for investment in subsidiary in the separate financial statement of the parent? Forgotten.
It has to be reported as equity. We report it under equity.
You report it under equity. How do you do that? What's the double entry for that?
You credit your equity, then you debit your bank, right?
Oh, that's a spam mate. When you're debiting bank, you are collecting money now. So why are you debiting bank? You invested.
Okay, you debit your investment, then you credit your equity.
Equity bow. You are not issuing shares now. It's only if you are issuing shares that you would credit equity. Debit equity.
Let me try, sir.
Okay, Sharafa.
So investment in subsidiaries is kept as a line item, as an asset on the face of the financial statement.
Okay.
And then and so that's debited. And then the means of payment of the consideration, whether cash or equity, is credited.
Thank you very much, Sharafa. That's absolutely correct. So that's the journal entry. However, in addition to that, what these guys are looking for, yes, you have mentioned it. You need to actually also mention how you measure that investment in subsidiary, the amount. Okay. So it's usually measured at the amount you paid to that subsidiary. When you invest in a subsidiary, you are paying the subsidiary. You will have paid him certain amount. So it's either measured at cost or it's measured in line with IFRS 9 fair value. You measure it at fair value. Okay, you need to mention that as well so that you can get your full 3 marks. Okay, I just needed to mention that. Yeah, Ahmed, go ahead, please.
Thank you very much, sir. The additional information 3 that we have under that Sokoto and Niger, whereby we have additional information 4, where Sokoto is owing Niger and Niger is owing. So I think we have element of cash in transit or check in transit here. But you said that we should just add the 2 figures together to deduct it from both sides in terms of payable and receivable. So do we need to look at it in terms of cash in transit of about the difference between the two, or what? Because I don't really understand why should we add the 2 together.
Well, there is no cash in transit here. There's no cash in transit. There are different transactions. So
Okay.
Niger owes Sokoto 280 for goods purchased. Okay, this a transaction, and Sokoto owes Niger 120.
Okay.
There are 2 separate transactions.
Okay.
Yeah.
Good.
So the 2 So the group together has a receivables of 400, have a payables of 400. Needs to be cancelled out. So that's it.
Thank you.
Yeah. Now, the one of November 2022, this one also, we're asked to prepare consolidated statement of financial position also. And also, they also gave that you should explain the term gain from bargain purchase and identify 3 items stipulated in IFRS 3 that must be reviewed. Now, let's start with this. You remember gain from bargain purchase. I explained that to you. And I told you it's the opposite of goodwill. And it occurs where the net asset acquired is higher than the purchase consideration. That's where you have gain from a bargain purchase. It is rare. It's rare. We don't expect that to happen, that our net assets acquired will be higher than what we are paying. Therefore, IFRS 3 requires that you need to reassess 3 items. Number one is the consideration transferred. You need to assess it. That did you calculate it very well? Number two, you need to reassess the determination of the net assets, the valuation of assets and liabilities. How did you have you properly valued the asset and liabilities of the subsidiary properly? You need to reassess that as well. In fact, you need to even reassess that have you determined all the reserves at the date of acquisition properly as well. You see, all the components that are involved in determining this amount needs to be reassessed. We need to look at them and see that have we done it very well, right? So that's that. Now, again, similar to what we have done above, this is not different. So in order not to bore you, I would advise you to read and solve this yourself. Try it, and see if you're able to solve it before you jump into the solution. It's nothing different. Everything is the same as cancellation and all that. So at least try the ones I have in the handout. I have the solutions here for you to be able to compare with. And there's this other one of May 2022, right? If you can try those 3, you are just good to go. And you'll be able to attack any question as it were. So this will expose you to quite a number of principles. And I've taken my time to not just solve those solutions, but to explain my solution to a large extent, to explain exactly what I'm doing to you. Okay? So let's try to do that. Now, let's go to investment in associates. What we have just looked at is investment in subsidiary. And we have really looked at consolidated statement of financial position. There is still consolidated statement of profit or loss that we need to look at. And I'm still going to teach you consolidated statement of cash flows, right? I will teach all of you that. But before I teach you that, we need to do statement of cash flows. And we are going to be doing statement of cash flows next week. And as soon as I'm done with statement of cash flows, I'm going to be teaching consolidated statement of cash flows. Before, we don't teach skills level that, but ICAN surprised, they surprised you guys like 2 days ago, and they asked it in your exam. So it was there. And it's nothing serious. It's simple. So we're going to be resolving all of that next week before we then touch on the few topics that we have left. You guys are almost done with your syllabus. Almost. By first or second week in April, we should be done if we are consistent with the way we are moving. So yeah, before we get to all that, I need to explain investment in associates. I've already identified or explained to you that investment in associates is a type of investment where an investor buys equity interest in an investee, and his holding in this investee is between 20% but less than 50%. I already explained that to you. And I've also told you that this type of investment gives the investor significant influence over the investee. It gives the investor significant influence over the investee. And I told you also what significant influence means. We have discussed that at length in our first class. You know that is the power to participate in the financial and operating decision of the investee. That's significant influence. Now, the focus is how do you account for an investment in associate as a parent, right? So, as an investor, where you have an investment in associates, you would usually account for that investment in your consolidated financial statements using the equity method. See, quote and unquote, in your consolidated financial statements. It therefore means that if you are not preparing consolidated financial statement for whatever reason, it means that you cannot use equity method. Equity method is for you already have a subsidiary. You now want to prepare consolidated financial statements, right? So when you want to do that, you apply what we call equity method. Now, however, if you are not preparing consolidated and you have an investment in associates, you must also recognize it in your own separate account as well as an entity. And that one is straightforward. You either recognize it at cost or you recognize it in line with IFRS 9 at fair value. Or you recognize it in line with IFRS 9 at fair value. So this is the first thing I need you to understand and appreciate, right? Because for investment in associate, it's different from subsidiary where you consolidate, right? All I've been teaching you all along is accounting for investments in subsidiary where you consolidate. This one, you are not consolidating. So when you have an investment in associates, if you are preparing consolidated financial statement, in that your consolidated financial statement, you would incorporate your investment in associates using what we call equity method, which I will explain very soon. However, in your own separate financial statements, you would put that your investment in associate either at cost, and you know what cost means, the amount you paid for that investment, or in line with IFRS 9, which is usually fair value. Now, I hope that is clear. Furthermore, all the principles I taught you under investment in subsidiary also applies here too. So you are exempted from equity method if the parent itself is a wholly owned subsidiary, which means that the parent the investor is not preparing consolidated financial statements, or the parent is not listed or in the process of being listed. You don't have to use equity method. You only need to incorporate that investment in your separate accounts at cost, the amount you paid. We also need to consider potential voting rights as well. Potential voting rights like instruments that has the potential to become ordinary shares, like warrant options, convertible debt, and all that. They need to be considered in determining whether you have significant influence or not. The same thing is that you cannot exclude an associate from the consolidated financial statement unless you have lost significant influence. Also, we expect that you should have a uniform accounting policy with your associates and also uniform reporting dates. And like I've mentioned, in the separate financial statements of the parent, the investment in associates is usually accounted for at costs or in line with IFRS 9. Okay, so all you're doing is you are just recognizing how much you paid for that investment by debiting investment in associate as a line item and crediting bank in your separate account. Also, since you are like an investor, they will pay you dividends. So any dividend you receive, you also recognize it in your separate P&L as dividend received as well. So please know this. You need to appreciate that idea that in your separate account, not in consolidated, in your separate account, it's just you will just recognize it at cost or fair value. How much you paid, and that's all. And when you receive dividend from the associates, that's an income in your P&L. However, in the consolidated financial statements, you would usually account for investment in associates using equity method. And when we say equity method, all you are doing is that you are going to be increasing the cost of investments with your share in the retained earnings of that subsidiary, of the associate. You are going to be increasing, you will increase that your cost of investment with share of profits. With share of profit. And if there is any impairment loss, you remove it. If there is any impairment loss, if your investment becomes impaired, of course, you deduct that. So the summary of it is that in a consolidated account, we don't consolidate associates. All we do is to present a separate line item. We call that item the carrying amount of investment in associates. And all you are doing is that the cost of your investment, you add your share of profits. You need to remove dividend because that would be recognized in your separate account. It's recognized as an income in your separate account. So it's an intra-group income, right? You would not consolidate that. That's why we have to remove that. Then if there is any impairment loss, you remove that as well. So this is the only thing that you put in your consolidated statement of financial position in respect of an associate. That's the only item. You don't consolidate associates like we do for subsidiary. No. This is the only thing you do. Anytime you hear investment in associates and you are preparing consolidated financial statements, you apply equity method. And this is what we mean by equity method. You determine the carrying amount of the investments in associates by increasing your cost of investment with share of profit of the associate every year. If the associate gives you dividend, you remove it. If there's any impairment loss on that your investment, you remove it. This is the only item that you consolidate. And that is all for associates. However, in addition to that, in the statement of profit or loss, in the consolidated statement of profit or loss, is all just one item. You don't consolidate as well. You don't add figures of the parent and associate together like we do for subsidiary. No. The only thing you recognize, just like you did for consolidated statement of financial position, for consolidated statement of profit or loss, you only take your share of profit of the associate. You just add it to your profit for the year. Your share of profit of the associate, you add it to your consolidated profit. And that's it. Just one line item. You're done. And that is it for associate. Now, with that understanding, if you understand that, then what happens if there are transactions between the parents and the associates? Now, if there are transactions between the parent and the associates, you see, income and expenses that are recognized or that arise from transactions between the two of them, you don't recognize them in the consolidated statement of profit or loss. You don't as well. Any income and expenses, you don't recognize them. However, if the transaction between the two of them gives rise to a profit, that profit also is an intra-group profit. That also needs to be eliminated. But here, because we are not consolidating, you are only going to eliminate that intra-group profit to the extent of the parent holding in the associate. To the extent of the parent holding in the associate. So the major questions you find the examiner asking you is that there will now be trading between the parent and the subsidiary and the associate. There will be trading between them and they will make profits. You have to eliminate such profits. But when you are eliminating it, you will not eliminate it only like you do for subsidiary. You are only going to eliminate to the extent of your holding in that associate. You will see how that works. And finally, where you have similar items of asset and liabilities arising from transactions between the parent and the associate, you don't cancel them out, though. You don't even consolidate them anyway. So let alone say you want to cancel. You don't consolidate parent with associate. So cancellation does not apply here. So the only thing we do is if they make a profit from one another, you need to eliminate, you won't consolidate that profit. But the profit you won't consolidate is to the extent of your holding in the associate. So let's use questions to clarify this. So what I'm saying is this. If a parent sells goods to associates and makes a profit of 100 naira, okay, and the parent has 25% holding in the associates, you know that the profit here that the parent made from selling to the associate is 100 naira. Now we are saying that this profit should be eliminated to the extent of the parent holding in the associates. Meaning what you eliminate is only 25%, which is my holding in the associates of this 100, of this unrealized profit. So the amount you would only eliminate is 25. Now, how do you do the elimination? Number one, the parent has made profits. Is the one that sold. So you are going to deduct that unrealized profit from the retained earnings of the parent. Number two, now the parent sold to the associate. That means the associate is carrying an inventory in his books. But we don't consolidate the account of the associates. We don't consolidate it. So that inventory that has a profit load is not in our consolidated account. So there is no way to remove it. So what will now be the other leg? Now, the other leg where we can reduce this from is the investment in associates that we calculated. That's where you are going to remove the other leg from. Because this is where that element of profits, okay, would be reflecting in our own consolidated account. So when you need to eliminate unrealized profits, especially if it's a transaction where it is the parent that sold. So you remove it from the retained earnings of the parents and from the investments in associates, because the other leg will have been inventory, but we don't consolidate associates. So there is no way we can deduct it from inventory. And that is why we are deducting it from investments in associates. Now let's look at the reverse. If it was the associate that sold to the parent, you know, this one, it was the parent that sold. Now it's the associate that sold. The associate made a profit of 100. And the parent holding is 25%. Again, there is intra-group profits. You can only eliminate it to the extent of the parent's holding in the associate, which is 25%. So what we eliminate is 25% of 100 naira, giving us 25. How do we eliminate this? Number one, we're going to deduct it from the retained earnings of the associates. Before we take our share of his profit, you remove that unrealized profit from the retained earnings of the associate in the consolidated account, of course. And secondly, you are going to remove it also from the inventory of the parent. Now, I can remove it from inventory here because the inventory is in the books of the parent, and it's the parent that is preparing consolidated account. So he can easily remove the profit load. Unlike this first scenario, the inventory was in the books of the associate, and we are not consolidating the associate, so there is no way we can adjust inventory that is not in our books. Okay, that's why we adjusted that unrealized profit through investment in associate. But for this one, where it was the associate that sold to the parent, so the inventory is with the parent, so we can easily deduct that unrealized profit from the inventory of the parent. And that is it for intra-group transactions. Okay, Mustafa.
Yes, sir. I want to ask, are we also assuming here that those goods are still in inventory and that what makes it unrealized profit, or it doesn't matter?
It matters. It matters. So we are assuming that they are still in inventory. If they are signing like this, you assume it's still within, it is unsold. It matters. If they have sold it out, then the profit becomes realized.
Okay, thank you.
Yeah. So I need more questions, please, because this is all for associates. Yeah, Ahmed.
What of if part of the inventory have been given out? Not all.
So it's similar, just like we did. It's only the portion that is unsold. So it's only that portion that will remove the profit load. It's only the portion that remain unsold. We did something like that. The same way. Just that after you have finally determined the profit load, okay, what you eliminate is to the extent of your holding in the associate. That is what you eliminate. To the extent of your holding. But the unrealized profits, the intragroup profits, is relating to the unsold stocks. Now, so far, what I've said is not much. Investment in associates, the way we account for it in the consolidated account is equity method. And when it comes to equity method, all you are doing is that you are getting your cost of investment, you're adding share of profit of the associates. If there's any dividend received or impairment losses, you remove it. That's all you do. And in a consolidated statement of profit or loss, you also take your share of profit for the year of the associates. You add it to the consolidated profit. And also, in a separate account of the parent, you also recognize that investment at cost or at fair value. That's all I've said. And when there are intra-group transactions, you eliminate any profits to the extent of your holding in the associates. You don't need to cancel out here, whether if there are similar assets and liabilities, because you don't consolidate. You don't consolidate. In fact, if you have any other assets in the associates, you add it as part of your investment in the associates in the consolidated account. So that is all. But remember that using equity method, you are adding your share of profit in the associate. What if the associate is making losses? What if it was losses is making? That means that your cost of investment will be reducing. So IAS 28 says that, because the standard that deals with investment in associates is IAS 28. It says that if that cumulative losses becomes or makes your cost of investment to be negative, as soon as it gets to zero, you stop, just exclude that investment in associate from the consolidated account, because we cannot have an asset that is negative. So you just stop. As soon as it decreases the cost of investment to negative, you stop. Okay, so that's the principle. Now let's solve some questions. So question 1 says company A owns 30% of the equity of company B that it acquired for 25 million and has a significant influence over it. Company B is not publicly traded and there is no active market for its shares. Company A chooses to account for all its associates at cost. How will company A account for its investment in this separate account? Very straightforward. At cost. In a separate financial statement, it should be at 25 million. So that means in this statement of financial position, you just have investments in associates, 25 million. Very straightforward. So that's all you do. Scenario 2, it says company X owns 22% of company Y, a listed entity on the Nigerian exchange group that it acquired for 105 million. Company X has significant influence over company Y. Company X chooses to measure all investment in associate at fair value through profit or loss permitted under IFRS 9. The fair value of the investment at the end of the year is 120. How should company X present investment in associate? Okay, this one, since company X chooses to use fair value through profit or loss, that means at the end, even though the cost of the investment is 105, at the end of the year, the fair value is 120. So it will recognize it at 120. However, since it has made a gain, because it was 105 before, and now it's 120, which means it has made a gain of 15 million. That 15 million shall be recognized in P&L, right? It should be a profit to P&L because this is fair value through P&L. So fair value, any changes in that fair value, recognize it to P&L. And that's how that works. So in a separate account, in the statement of financial position, the investment in associates, 120 million. The gain on investment, 50 million in P&L. So that is separate account. Now, let's look at consolidated accounts. So it says Pico, a company with subsidiaries, acquires 50,000 of 200,000 1 ordinary shares in ECO for 120,000 on January 1st, 2017. In the year to 34 December 2017, ECO earns profit after tax of 48,000, from which it pays a dividend of 12,000. How will ECO's result be accounted for in the separate and consolidated account of PICO for the year ended 34 December 2017? Okay, so for this one, they said, how will ECO's results be accounted for in the separate and consolidated account? So they want you to show how PICO will account for this associate investment in his own separate account and also in a consolidated account. Firstly, we need to get the holding. Our holding in ECO is, if you do 50 over 200, that's 4 times, that's at 25%. So which is associates? 25%. Associate is between 20 but less than 50%. So that's associate. The cost of the investment is 120. And the associate makes a profit after tax of 48. We pay a dividend of 12. Now, from what I've explained to you, even without me telling you, in the separate account, what the parents will recognize is just this 120,000 in his own separate statement of financial position. That's all. 120,000 at cost. Except if you are told that it usually measures it at fair value, then they will give you the fair value at the year end. But in this instance, at 34 December 2017, in a separate account, you will just put investment in associates. 120. In addition to that, in the statement of profit, in a separate statement of profit or loss, you will also recognize dividend received. Dividend received. Is it 12,000 or 30% of 12,000? So it will be 30% of 12,000. No, 25%, because he has 25%. So you just calculate 25% times 12,000. You will recognize that as dividend received, as an income in a separate account. That's all. That's all it does in a separate account. Okay? However,
Sorry, sir. Why did we remove 25% from the dividend paid of 12,000 naira?
how or why?
Why?
You know that the associate paid the dividend of 12,000 to all the
Yes.
shareholders.
The
So
12,000 is for all the shareholders.
yes, for all
His
the
own portion
shareholders.
of the share, 12,000 is 25%.
Thank you, Jamil. Thank you, Jamil. So yesterday, do you get it?
Yes, I do. Thanks, sir.
Yeah. Thanks, Jamil. So, in the consolidated accounts, like I told you, in the statement of financial position, he will need to determine the carrying amount of his investment. And all he's doing is he will get his 120,000. He will get a share of the profit of the associate, which is 25% of 48,000. And he will now remove dividend received, which is 25% of 12,000, just so that he will remove any intra-group transactions, because that dividend is recognized in a separate account, not in the consolidated account. And that is all. And in the consolidated profit or loss, all you recognize there is just a share of profits. It's just a share of profits. So this is what I've been explaining so far. So in the separate account of the parent, of the investor, in the statement of financial position, you recognize this investment in associates, 120,000. In the statement of profit or loss, you recognize this dividend received, 25% of 12,000, 3,000, and that is all. In the consolidated financial position, you would have carrying amount of investments, which is cost of investment, 120, share of profits, 12,000, less dividend received, 3,000. We have 129. So which therefore means that in a consolidated statement of financial position, I'll have investment in associates, 129, 129. In a consolidated statement of profit or loss, I get my share of profits, 12,000, 12,000. 25% of that which is like this one. So it recognizes it's 12,000. Another question. It says on 4th January 2017, people bought 25% shareholding in Apple at a cost of 76,000. During the year to 34th December 2017, ACO made a profit before tax of 164,000, and the taxation charge on the year's profit was 64,000. A dividend of 40,000 was paid on 34th December 2017. Out of this profit, calculate entries for the associates that will appear in the group account. Again, so in the consolidated accounts, all we recognize is my carrying amount of investment in associates, which we calculate as my cost of investment, which is 76,000, plus my share of profits. I have 25% times profit after tax. So this is PBT, this is tax. So I need to do 164 minus 64. Okay, I get the PAT. I apply my 25% on that. That gives me 25,000. That is my share of profit in the associate. Then I remove dividend. So the associate paid a dividend of 40,000. I take my share, which is 25% of that. I remove that. The balance gives me the value of investment in associates. That's the value of my investment in associate that I'm going to present in the consolidated statement of financial position. Another question. It says, set out below are the account of parent co and the subsidiaries and of associate co. It says parent co acquires 40% of the equity capital of associate co 5 years ago, when the latter reserves stood at 20,000. We're given the statement of financial position and also statement of profit or loss, and we're asked to prepare consolidated account of the parent. Now, in order to prepare consolidated account of this parent, so this parent has subsidiaries already, and now he has associates. And he has 40% of the associates. And he bought the associate 5 years ago, when the reserve of the associate was just 20,000. Now, they gave me statement of financial position, parent and subsidiary. That means this line here are consolidated accounts already. It's consolidated. And this is the figures of the associate. Now, when you want to prepare consolidated accounts, we don't add figures of associates. You won't consolidate like we are doing for like subsidiary. No, you won't be adding them together. No, what we do for associate is just for us to calculate the carrying amount of your investment in associate. That is all you do. And I will just get my cost of investment, which I will see in here. They gave me my cost of investment, which is 30. Okay, 30. I will just get my share of profit in the associates. And how do I get my share of profit in the associates? And I'll just look at, as far as this associate is concerned, what is his total profit to date? That's retained earnings of the associate, 50. Right? And at the date I acquired him, his retained earnings was 20. I cannot have a share of that. I don't have a share in that. That one was generated before I acquired the associate. So I removed, which is why I did 50 minus 20, which is 50 minus 20. So I take my share of that 40%, I get 12. So I have 42. So this 42 is my carrying amount of my investment in associate, which is what I will consolidate. That's the only thing. Then my retained earnings, because I usually take a share of the profit of the associates. So this is my retained earnings. You look at it. This is retained earnings of the parent and the subsidiary, 75. This is the retained earnings of the associate. Remember, there was a pre. So this is the post. We take a share of this. We consolidate that. We usually consolidate that. Our share of is post-acquisition profit. So we take 40%. So this is my consolidated retained earnings. So let's prepare our accounts. The first item here is tangible non-current assets. So this is it. Again, you are not going to add these two together. You don't consolidate associates. So I'm only going to have this on 110, and that's why I'm having 110 here. Secondly, this investment in associates, I've added my share of profit, so it's now 42. I'll consolidate that. Investment in associates, 42. Next, loan to associates, 10. In the associate account, you have loan from parents, 10. Don't cancel out this one, no. There is no, you cannot, because you are not consolidating. It's not like you are adding, no. So you will leave, you will still consolidate my other asset in the associate. My other interest in the associate, I consolidate it. So I will add this 10. Then the next item is current assets. Again, you are not consolidating. You only pick this one. That of the parent and the subsidiaries, 50. So 50. If I add them together, it gives me 212. That's my total asset. Then I move to my equity and liabilities. So under my equity, I have ordinary share capital. And my ordinary share capital will be that of the parents, the consolidated. I don't add this, so it's just 125. Okay, so that's 125. My retained earnings is the one I worked here. This is 87. So if I add the two together, it gives 212, which is a balanced figure with this 212. In the consolidated statement of profit or loss, again, you are not consolidating. You are not going to be adding, no. This is what you have, 14.5. You remove only this, and all you are going to add is just your share of profit of the associates, your share of this 25, and that's all, which is what we did. 47.5 minus the tax. Then I take my share of profit of associates, which is 40% of 25. And that's it. I add that to the group profit, and that's 40. It's no more. If you understand this one, you understand everything associate has to offer. It's no more than this. This teaches you the very foundation of it. Now, another question. Says PICO holds 25% of the equity of ACO. During the year, PICO makes sales of 500,000 to ACO at cost plus 25% markup. At the end, ACO has all these goods still in inventory. So here there's an intra-group profit of a markup of 25%. You cannot apply 25% on selling price. If you do that, you are wrong. You need to bring this 25% to 125%. So it will be 25 over 125 times 500, which is what I've done here. So the intra-group profit is 100,000. However, The unrealized profit that you eliminate is to the extent of your holding in the associate. You owe 25% in associate. So it's only 25% of this profit that you eliminate, which is 25,000. Now, since it was the parent that sold, that means the inventory is with the associate. So you cannot eliminate the unrealized profit from inventory. You can only eliminate it from the investment in associates. Why the other leg? Since it's the parent that made profits, you eliminate the unrealized profit from the retained earnings of the parent. I've mentioned this before. I'm just bringing it up again with examples. Another question. Says the statement of financial position of PICO and its investee companies, ESCO and JCO, at 31 December 2017 as shown below. So I'm given the statement of financial position of PICO, ESCO, and JCO. They give me a lot. And I was also given some additional information. And I'm asked to prepare consolidated statements of financial position as at 31st December 2017. So here now, I can see that PICO acquired 1.2 million ordinary shares in ESCO on 4 January 2010 for 2 million. When the retained earnings of ESCO is 400,000. So what is this information telling me? It's telling me that PICO acquire shares in ESCO, 1.2 million. So how many shares does ESCO has? That's 2 million. The nominal value is 1 error, so that's 2 million shares. So what is 1.2 divided by 2 million? Who has a calculator there? That's 60%. So ESCO is a subsidiary of PICO. And it is paying 2 million, which means that this is the purchase consideration. And the retained earnings of ESCO were 400,000. This is the pre-acquisition retained earnings. We're now told also that at that date of acquisition of ESCO, the fair value of its field premises was considered to be 800,000 greater than its value in ESCO statement of financial position. The building element has a remaining life of 50 years. So this is talking about revaluation surplus. There's a revaluation surplus of 800, which you are going to add to the field premises of ESCO. And we're also going to add it as part of net asset acquired because it's a pre-acquisition reserve. Also, they will be under depreciation. But since this is a property, and out of this entire value, we can only depreciate building. We cannot depreciate land because land has an unlimited useful life. The building elements has 50% value. So to determine our depreciation, it's just 800 multiplied by just 50%, then divide by 50 years. That will give me my depreciation I've not charged, which I will remove from the assets and also remove from the retained earnings of ESCO. I'll show you. Thirdly, PICO acquired 450,000 ordinary shares in JCO for 1 million when the retained earnings of JCO stood at 300. How many shares does JCO have? 1.5 million. Because this is 1 error, so 1.5 million shares. And the parent acquired 450,000. So how many? What was the percentage of that? 450 divided by 1.5.
30%.
That's 30%. So JCO is an associate. JCO is an associate. So ESCO manufactures a component used by both JCO and PICO. ESCO sells this component as cost plus 25%. Now, if I may ask you, this 25%, is it markup or margin?
It's markup.
Add.
Markup.
Mark.
Markup.
It's markup. because they mention costs. Because they mention costs. So costs, percentage, anytime they mention cost that's markup. Okay. So now Pico held 200,000 of these components, right? So there's an unrealized profit here, which is going to be 25 over 125 times this. Because this is at profit loading. So 25 over 125 times this will give us the unrealized profit, which we are going to eliminate by deducting from the retained earnings of ESCO and from the inventory of PICO, since it's sold to PICO. They said in the same period, PICO now sold to the associates, and JCO had 160,000 of these goods in inventory. And PICO too has marked up by 25%. Though this is markup. So the profit loading there is 25 over 125 times 160. That's the intragroup profit. However, what you eliminate as unrealized profit is to the extent of your holding in the associate. So it will be 30% of that intragroup profit. That's what you eliminate. We're now told that the goodwill in ESCO is impaired and should be fully written off. And there is also an impairment loss of 184,000 recognized on the investment in the associate. Okay, that's noted. Okay, non-controlling interest is measured at full fair value, and shares were trading at 1.6. And you know that when NCI is measured at full fair value, you will need to get the number of shares that the NCI holds. Okay, you multiply that by the share price of the subsidiary. So what's the number of shares? Since we have 30% of 2 million shares, that's like that's 60 or 600. That's 600 shares multiplied by 1.6. That gives us the value of the NCI. Okay, so that's all we do. So all I've explained, let me show you. Number one, I got the 60%. So NCI is 40%. Number two, the evaluation surplus is 800. So it's going to be a reserve, and I'm going to add it to the assets of the subsidiary. Then the additional depreciation. Building element is 50% because land is not depreciated. It's not a depreciable asset. So we get 50% of 800, which is 400. And that's what we are going to depreciate over the useful life. And since we acquired the subsidiary 8 years ago, so the year end is 2017, and we acquired the subsidiary 4th January 2010. Okay, so and this under depreciation is happening since the date of acquisition up till the year end. So that's why we are multiplying it by 8 years. So that's 64,000. This 64,000, we are going to remove it from the retained earnings of the subsidiary. Okay, because they have not charged this depreciation they is supposed to charge that he did not charge. We'll remove it from his profits. I would also remove it from the value of the assets because it's depreciation. Also, we computed the interest, our interest in the associate, which is 30%. And also, like I've explained, the intragroup trading, transactions between the parent and the subsidiary, we got the unrealized profit, which is 25 over 125 times 200, which is 440,000. We deduct it from the retained earnings of the subsidiary and from the inventory of the parents. For the transaction between the parents and the associates, again, the unrealized profit is 32,000. However, we eliminate it to the extent of our holding in the associates, which is 30%. So we do 30% of 32,000, and that's 96. Now, since it's the parents that sold, that means the inventory is with JCO. So we cannot remove this unrealized profit from inventory because we don't consolidate that. We can only remove it from investment in associates. And of course, we also remove it from retained earnings of the parent, since it's the one that made the profit. And that is all the additional information. So what is left is just to write off whatever goodwill we compute and also to impair our investment in associates. That's all. So we want to start doing our cancellation. For the subsidiary, I paid 2 million. Look at it here. We paid 2 million. Okay. The value of the NCI, like I told you, is 40% of 2 million times 1 point. Is it 40% or 30%? It's 30%. No, it's not associate
It's
now.
40. It's 40.
It's 40%. So that gives us 1,280. So if I add the two together, it gives me 3,280. Cancel it out against the net asset acquired. The share capital of the subsidiary is 2 million, which is this. Then this is the pre-acquisition retained earnings, 400. And we'll also consider the pre-acquisition reserves, evaluation surplus as well, 800. So 2,400,800, 3.2. So we have a goodwill of 80, which we're told in the question that the goodwill in ESCO is impaired and should be fully written off. So there will be impairment of goodwill of the entire 80. The entire 80. Now, this entire 80, because NCI is measured at fair value, NCI too will suffer in this impairment. So this impairment loss will be deducted from the retained earnings of the subsidiary so that NCI too can have a share of that loss. If NCI was measured at proportionate share, it's the parent alone that will have suffered the loss, and we will have deducted this loss from the retained earnings of the parent alone. But now, the two of them has to suffer, both parent and NCI. Now, the consolidated retained earnings. So as at the year end, the retained earnings of the parent is 2,920, subsidiary 1,770, associate 780, and this is it. Those are the retained earnings at year end: 2,920, 1,770, and 780. So I remove all the pre-acquisition retained earnings. That of subsidiary 400, that of associate 300. This is it. 400 for subsidiary, 300 for parents. Those are pre. We need to remove that so that we are left with what we can share. Now, for the subsidiary, before we share, there are some adjustments that we have made to these profits, like the depreciation that has not been charged of 64 that we computed up there. We need to remove it. Like the unrealized profit, the profit he made from selling to the parent of 40, we need to remove it. And the impairment of the goodwill, we need to remove them. Okay? So this is the depreciation. This is the unrealized profits. And this is the impairment loss. All worked out. Additionally, whatever is remaining will then be shared between the parents and the NCI. While this one is only the parent that will take his own share, is 30%, and that's it. Okay. But yeah, he will take his own share. And that is it. However, before then, the parent also suffered, he also made some unrealized profits of 9.6 that we say we need to remove from his retained earnings and also from investments in associates. So we remove this. And we were also told that the investment in associate was also impaired by 184. And this is it from the question. Impairment loss of 184 is recognized in investment in associates. So the parent will suffer that loss fully. Of course, he's the only one that have investment in the associate. So now, in ESCO, I'll take 60% of his remaining profits, which we got as 1186. I will take 30% of the profit of associates, which is this 480. So by the time I add my share of profit from the associate and the subsidiary to these other ones, okay, I get the consolidated retained earnings of this. Then my NCI, the value of my NCI, I usually pick it from here. This is where I usually pick it from. 1280. Then it will take his own share of the profits of the retained earnings of the subsidiary, which is 40% of these 1186. So I add these two together, I get this. Then my investment in associates, which is my carrying amount of investment in associates. I get my cost of investment, which is 1 million. This is it. This is 1 million. That is how much I bought the associates. 1 million. I will add my share of profit of associates, which is 144. That's 30% of this 480 that we got up here. That's the post-acquisition profit of the associates. Okay. I had it. And remember, the unrealized profits of 9.6 that we say will remove from investment in associates, this 9.6, and also the impairment loss of the investment in associates. So we are left with this. And that is all. So what is left is to consolidate. And remember, when you are consolidating, you are only going to add these two together. You are not consolidating J code. You don't consolidate associates. You are adding parent and subsidiary. And any adjustment are made appropriately, like we have done here now. So for the freehold, I only add parent and subsidiary, and I deducted that depreciation. And I also added that evaluation surplus. The same thing for this plant and machinery. I only added parent and subsidiary. Then the only thing I introduce for associates is just that my investment in associates, which is 950.4. That's the only item I introduce. Then for my inventory, I remove unrealized profits. And remember, what I'm adding is parent and subsidiary alone. The same thing for this, for this. Then for my equity, these ordinary shares is the ordinary shares of the parent alone, because that of the subsidiary is cancelled out. Associate, I don't consolidate that. This is the consolidated retained earnings as worked out up there. In my workings, this 3582 is this 3582 here in working 6. Then NCI is for my workings as well. 1754 in working 7. Okay. Then loan stock 1.2. Let me see. It should be parent and subsidiary. Yeah, 1.2 parent and subsidiary. That's the only thing you consolidate. Payables, parent and subsidiary. Bank overdraft, parent and subsidiary. If I sum this together, I get a total of 113,716.4, which is the same thing as my total assets. Okay, so this is everything about investment in associate. It's not more than this. It's not more than this. Now, the final thing left, which I'm not going to do tonight, is consolidated statement of profit or loss. Okay, I will do that on Sunday. You know that we missed a class last week because of the program I went for. So we're going to be making up next week. You just need to make that sacrifice, which you're going to enjoy later anyways. So we would have to start our class from 11 as well. We'll have like almost 3 sessions and start on Sunday. We'll finish up this in our first period. We'll finish up this P&L. Then if we can solve some past questions, we'll solve some past questions. We shall finish up this. So if you're able to finish up this one, if you're able to finish up this, then in our second period, I would start cash flow with you, statement of cash flows. And that's what I will do for second and the period in the evening. I can't, cash flow will take some time because I will need to solve as many questions as possible just for you to get used to it. Then, when we are meeting upper week, then we'll do consolidated statement of cash flows. We'll do consolidated statement of cash flows. When we are done with that, then we would then look at what else we want to do. Look at what else we want to do. The most important thing that is next that we need to do. Okay. Yeah, David, I can see your hand. Go ahead, please.
So sorry, did you say that when calculating NCI, if there's impairment using fair
I
value,
can't hear
should
you.
be shared?
What did you say?
Okay, like if you're using fair value, both parent and NCI are supposed to suffer the impairment.
Yes, that's correct.
Yeah, I don't think I saw impairment while you're calculating NCI.
It has been treated indirectly now. We took out the impairment from the retained earnings of the subsidiary. And you know that the retained earnings of the subsidiary, the post is shared between the parent and the NCI. So what the two of them is sharing has reduced by that loss. That's the smart way to do it. You cannot be doing it separately. You will do it in parent, we do it. When there is something the two of them share, which is the retained earnings of the subsidiary, reduce it from there. Automatically, they are taking a share of the loss. Automatically, they are taking a share of the loss. All right. Any other questions? All right. Thank you very much. I'll see you next time we meet. Bye.